Okay, my name is Dr. Hugh Macartney. I'm an associate professor at the University of Birmingham. If you're watching this and I've ever taught you as one of my students, you know that I hate using PowerPoint. I believe that it kind of puts our brains to sleep. And so today, for the purposes of this short mini lecture that our department, for a series our department is putting together, I decided to use my kids' notice board. I apologise for the slight shine. I apologise for the fact my next door neighbour has just started cutting his lawn. My kids are bouncing on the trampoline and you may hear them screaming. Hopefully no one dies. We should make it through. So I'm a political economist by trade. I spent the last 15, 16 years working on banking, financial market regulation, central banks. And what I love about the field that I work in, about political economy, is that I've always believed in a sense that so much of what matters about the world economy, about the world we live in, if you like, if you think in economic terms, is the detail. And political economists have a real interest in the detail, in the minutiae of particular things. But also, political economy tries to map and think about the kind of big trends and big processes and concepts out there in the world, and the kind of, I suppose, if you like, the kind of direction that history is taking. It's not simply the very concrete details, but often thinking in abstract terms helps us understand what's going on as well. So I want to talk today just very, very briefly. This feels very odd using this. This is usually filled with my kids' weekly schedule, but anyway, here we go. So I want to talk very briefly today for a few minutes about the COVID economic recovery, if you like, what we might be thinking about in terms of an economic recovery after or in and through this COVID period. And I want to talk about three things very briefly. Firstly, about central banks. Here's my silly emoji that I've drawn up the side, but central banks and the role that they've played in the last 10 years, particularly after the global financial crisis, and some details about them now and their role in the recovery after COVID. Secondly, I want to talk about governments and government spending and the role that they're likely to play. We're already seeing, in a sense, the role they're playing and the role they're likely to play over the next few years. And thirdly, I want to finish up with three big factors. I'm sorry, I like to work in threes. Here we go. So three, and three big factors towards the end, things to have an eye on. Okay, starting with central banks. I think the big point, I'm a big believer in, the idea that nothing ever happens in a vacuum, in a sense, that actually understanding the stage we're at now in early 2020, we need a bit of an understanding of how we got here and what was going on in the lead up to this. We're not starting the COVID response, if you like, and the economic recovery from square one, with a kind of blank sheet of paper, if you like. And the last 10 years have basically, post-financial crisis, 10, 12 years, have been dominated, I would say, by central banks. There's a reason for that. Insofar as most Western governments, around about 10 to 12 years ago, made some decisions that they were going to focus on various, you might have heard various different terms used, but basically balancing their books, cutting budgets. Austerity was the term that often got attached to that. I'm not a big fan of austerity. I think many of us have seen a lot of the problems associated with cutting government budgets, particularly when it's related to social spending and welfare and all those kinds of things as well. But anyway, from the perspective of central banks, this was a hugely important decision, because governments made a decision after the financial crisis that the route forward, the way of promoting economic recovery, wasn't going to be through more government spending. It was going to be through what we would basically call monetary policy, that they handed responsibility over to central banks and said, look, it's going to be your job to promote some kind of economic recovery, some kind of stimulus, some kind of way of getting the economies globally rolling again. Without getting lost too much in the terminology today, we would often refer to that then as loose monetary policy. So central banks have a range of different tools or instruments in their arsenal, in their toolkit. And, broadly speaking, what we've seen over the last 10, 12 years are loose monetary policy tools. So central banks loosening or lowering interest rates, relatively new measures, certainly for the Western world, like quantitative easing, they come in various different packages, but they're basically forms of bond buying, government bonds, corporate bonds, and so forth, and things like that. But they're measures basically of trying to promote some kind of recovery. I'll come back to that in a second, but through looser, more relaxed monetary policy, less restrictive monetary policy. Now, I think that has a very, understanding that one part of the response to the global financial crisis is very important for understanding what's likely to happen now, and part of what we are already seeing happen with the COVID economic response. And that's probably primarily because central banks, I think, and this takes us on to our second point here, central banks are now likely to play far less important a role in this economic recovery, if we can call it that, than they did in the aftermath of the financial crisis. There are a number of reasons for that. And if you think about this, historically, and I keep referring back to this 10 to 12 year period, but rates have been historically very low. I remember, early 2000s, 2003, 2004, shopping around for my first mortgage. And, mortgages, interest rates at the time were around about 4.8, 4.7%. If you put that in context, we're now down to 0.5, 0.75, 0.25%. I mean, interest rates from central banks have been brought down to historically low levels. Now, that has two implications. One, it gives, just in very kind of crude terms, in terms of interest rate movements, it gives central banks very little room to maneuver. But it also has a second implication, because what central banks tried to do alongside lowering interest rates was also to introduce what I called before quantitative easing measures. Now, actually, there's a whole school of thought about how effective quantitative easing measures are when interest rates are low anyway. Most people who would buy into that kind of school of thought say that quantitative easing isn't going to be very effective at all when interest rates are actually close to the zero lower bound. But that doesn't matter for us now. What it does mean, though, is that when we look at studies done about quantitative easing over the last 10, 12 years, they're pretty ambivalent, they're pretty agnostic, they're pretty, how do I put that slightly differently? It's not that convincing, the evidence that these quantitative easing measures have actually helped boost an economic recovery. Now, they may have done other things like help fight inflation or stabilize the economy, etc., things like that. So it's not to say that they had no effect at all. But in terms of boosting the economy and getting the economy, the global economy or national economies rolling again, the jury's out. That's why I say that I think, this is why my silly little emoji face here, central banks, I think, are likely to play a less important role in some kind of economic recovery now than they were expected to play in the last 10 to 12 years. That kind of leads us, again, back to my second point here, which is that I think what we're already seeing, is the importance of, if you want to call them, these fiscal policy measures, government spending, hence my silly little happy emoji. I don't know if happy is the right, happy and sad, but anyway, less of a role for central banks, more of a role for governments and for government spending, for fiscal policy. And we've already started to see the importance of government policy, fiscal policy, in the last few weeks and months. Governments have stepped in to support wages, governments have stepped in with loan schemes for businesses of various different scales and types. And this is where I say, as you're hearing this, 2 days from now, 2 hours from now, this may all have changed quite dramatically, but the trend we're starting to see at the moment with fiscal spending and government spending seems to fit with my kind of understanding of the lesser importance of central banks and the greater importance of governments and fiscal policy over the next few years. So in closing, what are the three big factors then that kind of, I think, and to a degree, they're three unknowns. There's always, I think, a little bit of, if history follows some kind of linear path, we can get a little bit of a sense of how these three factors might play out. But a lot of this is still unknown. What are these three factors? Well, the three factors that I think are going to be most important. Number one is the virus itself. I'll come back to that. Number two is the length and shape of the recovery. And number three has to do with China. So three factors. Let me talk about them very briefly in turn. Now, I'm not an expert on viruses. I wouldn't claim to be. When I talk about COVID recovery, I'm talking about an economic recovery. I hope you didn't log into this video expecting some kind of, medicine, right? That's not what I'm about. So I'm no expert in that, but everything that I hear and see in the media, in the news, and economics reports says that obviously what we're trying to do now in terms of what they call flattening the curve or lowering the number of daily death rates and things. We don't exactly know, firstly, how successful that is going to be, how long that process is going to take, whether there's going to be a second rise once we start to reduce restrictions and lockdowns and all those kind of things at all. So that first factor about the virus is hugely important for economic reasons. Let me explain a little bit why I think that might be the case on the second point. The second point is also a temporal, a time-related factor, right? So the recovery itself, that the virus matters in economic terms because it's going to affect the shape, the state, the success rate, if you like, of the economic recovery itself. We've seen, as I said, a lot of government spending packages put together, but a lot of them have a very limited time horizon. Now, you could hear that a number of different ways. You could hear what I'm saying as me inferring that the government has a kind of limited budget. That's not actually what I'm saying, but what I think is important to bear in mind is that the kind of measures the government has introduced, I say the government in the UK, government in the US, other governments in Europe, and to a degree the kind of negotiations going on with the ECB, the European Central Bank, as well. I'll maybe come back to that in a second. But these things have a limited time horizon. Why? Because at a certain point in time, decisions are going to have to be made about, do we continue to expand this government spending indefinitely? What happens if this economic recovery takes us 5 years, 10 years? What happens if we are thinking about something like a Great Depression? How do we manage that? And there are going to be some politically contentious decisions to be made about this factor. Right, the government spending longer term in promoting an economic recovery. Decisions about either, well, look, somehow we've got to raise revenue from somewhere. And this is why I say these are going to be politically contentious, very, non-trivial decisions to be made. Where is that money going to come from, if you want to put it in those terms? One option is to raise taxes on higher income earners or corporations. That's always been a challenging one for governments to go after. Another one, and this was hinted at by I believe the chairman of the ECB, of the European Central Bank recently, that maybe what we'll need to have after this is another period of cutting budgets and more austerity. And again, that's going to be seriously important in political terms if a government comes on the scene and, which government is going to want to, under these kind of conditions or in a couple of years' time, be saying, okay, well, we need to revisit the austerity debate. Again, I think those are going to be very important. I'd also say something else about the second factor, about economic recovery, because there are a lot of decisions that are being made now that seem to be kind of, if you like, kind of short-term, immediate decisions, but that are going to have very long-term implications. Let me give you one for an example. So decisions are being made now about lending packages to smaller and medium-sized businesses. Now, generally speaking, in most of the Western world, smaller and medium-sized enterprises, businesses, firms, they're considered to be the lifeblood of the economy. So keeping them alive or afloat, if you like, during this time when they're not receiving the income, they're not able to pay wages, that's a hugely important issue. So various governments have introduced various different kind of schemes, or they've guaranteed and they've said, look, we'll underwrite, if banks lend to smaller businesses, we'll underwrite 100% or 80% of those loan packages. Now, again, you might get lost in the detail of this, and in that I don't want that to happen. But those kind of decisions are very important. Why? Because if I was to put it in very kind of crude and simple terms, if all loans are underwritten for all businesses through this period for short to medium length of time, well, then you have the risk of all sorts of loans being handed out to firms that may longer term not actually be able to repay those loans, in which case you have a massive, if you like, kind of non-performing loan problem. The economy will go through all sorts of challenges if one set of policies are pursued. If at the other extreme, governments or banks decide, well, we're gonna be slightly more restrictive in terms of what we're lending out, and at the moment in the UK, that's kind of what we're seeing a little bit because of the terms of the deals that are being struck. I think I saw recently that only 2% of those smaller businesses under 25 that were applying for loans under £25,000 had actually been approved. That's a seemingly banal little detail, but actually it's going to have huge implications for those firms. If they can't access those funds in the short term, the immediate term now, then we're going to be facing some kind of economic collapse for those firms in the very near future. So these kind of small decisions that are going on now are likely to have very long-term implications. So we've talked three factors. We've talked about the virus, the kind of the time factor there. We've talked about the recovery and whether, how long we're actually thinking this recovery, when the recovery might start and how long that recovery might take. I've heard people say, well, we might see something towards the end of this year, some kind of recovery then. Others have said it may take longer. Others have said it may be sooner. Truth is, we don't really know at this stage. But the third factor I think to emphasize has to do with China. China has experienced its first, you've probably seen this in the news if you followed anything around this over the last few weeks, but China's experienced its first dramatic fall in GDP growth in decades. Okay, China is now starting to recover and to get its, I suppose, kind of engine rolling again slightly faster than we're seeing in the Western world, or slightly earlier at least. They're already experiencing challenges with restarting the Chinese economy, if you like. But one of those that I want to focus on now that I think is going to have an impact on us in the Western world is that, and it's a kind of a history repeating itself kind of thing. If you think back after the financial crisis, China had two problems, I suppose, after the financial crisis. One of them was particularly linked to the fact that demand for Chinese products around the world had essentially dried up. We were going through a financial crisis, a credit crunch, and all these kind of things. China had this big problem. I often say to my students, it's a little bit like China had produced a whole lot of stuff and had nowhere now to send it and to sell it. That's a little bit crude and offensive to Chinese people. I apologize, but for the sake of explaining it to second and third year undergraduates, that usually kind of works. So China had all this stuff. What was their solution to that? Well, the Chinese government made some decisions about relaxing credit controls and things and basically lending to their domestic economy to get people to kind of start to buy domestically. That solved an immediate problem for the Chinese economy. It actually helped China recover from the financial crisis faster than a lot of other places. It actually helped in the longer term the global economy recover. China's in a very different situation now. China now has the legacy of a lot of debt from that period, a lot of that which is now actually non-performing debt, bad debt. It solved one problem. This is often what happens with debt, unfortunately. It solved one problem, but pushed that problem further down the road. And China is now in a very different situation. So China has now got a problem of trying to kickstart its economy, but with this huge big debt problem that it has as a legacy of 2008. So that's why I say that I think the three big factors that will play a determining role for us, if you like, in the Western world, have to do with the time, related factors to do with the virus itself, the recovery and exactly how long, when the recovery starts, how long the recovery takes, what are we talking about in terms of recovery, and the third factor has to do with China. So three big messages we've covered just very, very briefly today. The first one was to do with central banks and the role that they played after the financial crisis and the role that they're likely to not be playing, or certainly the prominent role that they're not likely to be playing now. Secondly, shifting from monetary policy to fiscal policy, government spending, right? So we're already seeing some kind of evidence of that actually governments and government spending are solving some immediate problems, but they're going to lead to some very politically contentious decisions that may well lead to, it's one of the things we saw after the financial crisis 10 years ago was changes in governments from centre left to centre right, for example, 2008, 2010, the aftermath of that. We may be seeing some very politically contentious decisions related to government spending, but I also think there are three other factors in closing. One to do with the virus, one to do with the state shape, length of time of the economic recovery itself, and the third one to do with China.